America once again finds itself standing at the edge of economic uncertainty. Across major cities and small towns alike, a quiet fear is spreading through offices, factories, and homes. Employees who once felt secure in their jobs are now refreshing email inboxes with anxiety. Corporate announcements are coming in waves. Another company cutting staff. Another industry slowing hiring. Another round of layoffs. The question echoing across the nation is simple yet terrifying. Is America heading into another massive layoffs wave in 2026? Over the past few years, the United States economy has experienced dramatic shifts. Inflation surged. Interest rates climbed. Consumer spending fluctuated. Global conflicts disrupted supply chains. Artificial intelligence accelerated automation. And now, in 2026, the pressure seems to be building once again. Layoff announcements are no longer isolated headlines. They are becoming a pattern. Large technology companies that once hired aggressively are now restructuring. During the post-pandemic boom, corporations expanded rapidly, expecting continuous growth. But growth slowed. Profit margins tightened. Investors demanded efficiency. And efficiency often means fewer employees. Executives call it optimization. Workers call it job loss. The tech sector is not alone. Retail chains are reporting weaker sales. Manufacturing output is fluctuating due to global demand uncertainty. Financial institutions are adjusting their workforce as lending slows under higher interest rates. Even healthcare systems are reorganizing budgets due to rising operational costs. The Federal Reserve's aggressive interest rate policies over the last few years were designed to combat inflation. Higher rates cool down borrowing. They slow spending. They reduce economic overheating. But they also increase the cost of business expansion. When borrowing becomes expensive, companies delay projects. When projects are delayed, hiring freezes begin. And when profits shrink, layoffs follow. The American labor market had remained surprisingly resilient despite recession fears. Unemployment stayed relatively low. Job openings remained strong. But now economists are noticing subtle warning signs. Hiring growth is slowing. Temporary contracts are not being renewed. Corporate earnings calls are filled with cautious language. The word restructuring is appearing more often. At the same time, automation and artificial intelligence are accelerating workplace transformation. AI systems are replacing routine tasks in customer service, logistics, accounting, and even software development. Companies argue that technology increases productivity. But workers worry that productivity gains mean fewer positions available. The speed of technological replacement in 2026 is much faster than previous industrial shifts. Small businesses are also feeling the pressure. Rising rent, energy costs, insurance premiums, and wage expenses are squeezing margins. When small businesses struggle, local employment suffers. And when local employment declines, communities feel the impact immediately. Consumer confidence plays a major role in employment stability. When Americans feel secure about their jobs, they spend more. When they fear layoffs, they save more. Reduced spending hurts businesses further, creating a cycle of economic slowdown. That psychological effect can amplify downturns. Even before official recession numbers appear, Wall Street reacts quickly to economic signals. Stock markets often anticipate layoffs before the general public feels them. Investors reward companies that cut costs aggressively. Ironically, when corporations announce layoffs, their stock prices sometimes rise. This sends a complicated message. For investors, layoffs signal discipline. For workers, they signal insecurity. Another factor contributing to the layoffs wave discussion is corporate debt. During years of low interest rates, many companies borrowed heavily. Now, with higher refinancing costs, debt payments are rising. To manage these obligations, firms are trimming operational expenses. Payroll is often one of the largest expenses on any balance sheet. The real estate sector is also under strain. Commercial office demand remains uncertain as remote and hybrid work models continue. Empty office buildings mean reduced revenue for property owners. Construction projects are slowing. Job opportunities in related industries decline as a result, Manufacturing in America is facing mixed signals. Some sectors benefit from reshoring and domestic production incentives. Others struggle due to weaker global demand. Exports fluctuate with currency shifts and international trade tensions. This unpredictability makes companies cautious about expanding their workforce. Political debates are intensifying as economic uncertainty rises. Lawmakers discuss stimulus options, tax adjustments, and regulatory reforms. However, policy solutions often move slowly, while corporate decisions happen quickly. Workers cannot wait for long legislative processes when layoffs are announced overnight. Middle-class households are particularly vulnerable during employment waves. Many families rely on dual incomes. Mortgage payments, car loans, healthcare costs, and education expenses leave little room for emergency savings. Even short periods of unemployment can create financial stress. Young graduates entering the job market in 2026 are facing a different environment compared to previous years. Competition for entry-level roles is increasing. Internship conversions are declining in some industries. Employers are prioritizing experienced candidates who can deliver immediate productivity. The gig economy is expanding as a fallback option. Freelancing, delivery services, remote contracting, and digital platforms are absorbing some displaced workers. However, gig work often lacks benefits, job security, and long-term growth opportunities. Banks are monitoring credit risk closely. If layoffs accelerate, consumer loan defaults could increase. Credit card debt levels remain elevated compared to historical averages. Auto loan delinquencies are showing early signs of stress in certain income groups. Financial institutions are tightening lending standards cautiously. Despite these concerns, not every industry is shrinking. Energy, cybersecurity, defense, and certain healthcare segments continue to show resilience. Economic cycles rarely impact all sectors equally. The question is whether job growth in strong sectors can offset losses elsewhere. Economic history shows that layoffs often come in waves. Initial cuts are followed by second rounds if conditions do not improve. Companies prefer early adjustments to avoid deeper restructuring later. This creates ripple effects across supplier networks and service providers. Public perception can shape reality. If enough companies believe a slowdown is coming, they act defensively. Defensive actions slow growth further. This self-reinforcing cycle is what economists call a confidence-driven downturn. Housing affordability remains a central issue. High mortgage rates have reduced home buying activity. Construction hiring has cooled in certain regions. When housing slows, related industries such as furniture, appliances, and building materials also feel pressure. Another dimension is global uncertainty. International conflicts, trade disputes, and energy market volatility influence American corporate decisions. Multinational firms adjust global workforce strategies depending on regional performance. Inflation trends in 2026 appear more stable compared to previous peaks, but core prices remain sensitive. If inflation resurges unexpectedly, central bank policies could remain tight longer than expected, prolonging hiring hesitation. Technology transformation is perhaps the most powerful structural shift happening simultaneously. AI-driven automation reduces administrative workload, customer service demand, and data processing roles. Companies are investing heavily in digital infrastructure rather than human expansion. Corporate earnings guidance has become cautious. Analysts are revising growth projections. When revenue expectations fall, hiring targets shrink accordingly. At the same time, labor unions are becoming more vocal in certain industries. Workers demand job security clauses and stronger severance protections. Negotiations between management and labor are intensifying in manufacturing and logistics sectors. Government data releases in early 2026 show mixed signals. Employment numbers still reflect overall strength, but forward-looking indicators suggest moderation. Economic turning points often appear gradual before becoming obvious. The psychological impact of layoffs extends beyond numbers. Stress, anxiety, and uncertainty affect productivity. Employees who survive layoffs may experience survivor's guilt and reduced morale. This can lower efficiency further. The central question remains: Whether the layoffs wave will remain contained within specific industries or spread broadly across the economy. Historically, widespread job losses signal deeper recessionary forces. Targeted layoffs may represent sector-specific adjustments. Investment infrastructure projects may provide a buffer. Federal spending on transportation, renewable energy, and technology modernization could create employment opportunities. However, project timelines vary by state and region. Regional differences are significant. Technology-heavy states may experience sharper corrections if the sector contracts further. Energy-producing regions may see stability. If global oil demand remains firm, the American consumer remains a powerful economic driver. If household spending holds steady, businesses may avoid drastic cuts. But if fear dominates, caution becomes contagious. Economic forecasting is never precise. Analysts debate whether 2026 will bring a mild slowdown or a sharper contraction. Data revisions can change narratives quick.